Well, May has been a volatile month for the stock market. This comes amid concerns over inflation and how the Federal Reserve might respond. So joining us now to discuss how to navigate a zigzagging stock market is CBS News business analyst Jill Schlesinger. Thank you so much for joining us. Jill, Jill, there is the stock market and there's the economy. And sometimes the two tell us about each other and sometimes they just seem to be working in opposite directions. So I will start with this. How is the economy doing as it rebounds from the pandemic? And what is it telling us about where the markets are heading?
Let's take this back and peel it back a bit. Okay, the economy is doing quite well. It expanded at an extraordinarily strong pace as we look at the first quarter reading, a 6.4% annualized pace, huge numbers. And if you look at the full year, most economists believe that we are going to see growth of around 6 to 7% this year. Now, I know it's coming off of a lousy year last year, but that would be the strongest year of growth since the 1980s. So I think the economy is recovering. A little bit of fits and starts in the labor market, but we're going to watch that going forward. So far, so good for 2021 and the overall economy. Now, here's a funny thing. As you note, the economy and the stock market are two different animals. And what is the stock market? The stock market is a bet on where you think companies are going to be making money and how much they can make over the course of a year or maybe a couple of years in the future. It's why the stock market is considered a leading indicator of the economy. It's not the economy. And sometimes these two things, the economy and the stock market, can move in different directions. So the economy is expanding, usually good for the stock market, but the stock market can go down pretty dramatically at any given moment, and it's disjointed from the economy at points.
Mm-hmm. So Wall Street is worried that inflation could hurt stocks. Should the average investor be worried too?
Well, I think that all of us should worry about inflation. Okay, there's no doubt about it. The cost of everything going up is not good for anyone. So it's not good if you make $15 an hour. It's not good if you're on a fixed income and your prices you're going up while your payments and your income from Social Security is kind of stable. As an investor, inflation is really tricky because what happens with inflation is it erodes the value of your bonds, your safer investments, not safe, but safer. There are, however, some really important concepts here. Even if you think inflation is coming, I don't think you should just abandon every single bond position. What it means is that you've got to be careful about what types of bonds you own, maybe shorter to intermediate term, meaning no 30-year bonds. And maybe when you look at your stock portfolio, you've got to make sure that it is perfectly diversified across lots of different types of stocks. And what we actually know over the long term about inflation and even rising interest rates is that it can hurt in the short term, but over the long term, if you stick to your diversified portfolio, you're going to be okay.
We have heard rumblings about a market correction. So first, just explain what that is and what should investors do in the event that it occurs.
Market corrections, meaning a 10% pullback from what you've just seen, right? So your recent high, you're down 10% from that. They occur all the time. So I have to tell you, unfortunately for you, the price of admission to being an investor is that you have to endure corrections. You have to endure bear markets, which are 20% drops. You know, last March, we saw the market drop by 1/3 in 5 weeks. And now look at the recovery in the markets that has occurred. You have to, as an investor, be really steely during these tough times. I'm pretty sure you and I had some hits last year where I was saying, hang on, it's white knuckle time. Please try to make sure that your stock positions are in line with what you can handle risk-wise, but don't just bail out because things go down. The idea that a 10% correction is coming, it's not rocket science. Of course it's coming, but you are not trying to time the market. You are not trying to guess the top, the bottom, when the correction's coming, when the bear market's coming. Again, I sound like I'm pretty much of a broken record here, but if that diversified portfolio is set up correctly in the beginning, you should not have to worry about the market dropping 10 or 20%. You're a long-term investor, and I know that you've made that pinky swear with yourself not to panic at the bottom and not to pile in when the stock market is rising.
Yes, keep a level head. Jill Schlesinger, thank you very much.